let's say you're a divorce attorney and you charge somebody for professional services rendered in conjunction with your divorce, and you charge someone, let's say, $10,000 for that, and you hand them a copy of a book. As part of that, you give them a book that talks about getting on with your life after divorce. That by itself would not create an event that was subject to sales tax. However, if you charge a person $9,995 for the professional services that you rendered, and then you turn around and you say, I'm going to give you this book, I'm going to charge you $5 for it, that charging them of the $5 becomes a taxable event, and you actually need to be collecting sales tax on the sale of that book. So you become a retailer for purposes of that book. So you need to be careful what words you put in your bills and how you approach that. Otherwise, the Wisconsin Department of Revenue will find you. I'm David Elmer. I'm a CPA. I work at Jannsen Company, which is a public accounting firm, a CPA firm in Pewaukee, Wisconsin. Focus my presentation was tax implications and entity types of people forming law practices. When you decide to start a business, you have several different choices, and I'm kind of preaching to the choir, but you can form as a proprietorship, you can form as a partnership, you can go as an S corporation, a C corporation, you can be an LLC, you could probably even be an LLP. Several of these are intertwining. You could choose to be an LLC, which is a favorite form for people. It gives you the flexibility of being an LLC with the entity disregarded and being taxed as a proprietorship. You can choose to be an LLC taxed as a partnership, an LLC taxed as an S corporation, or you could choose to be an S corporation or a partnership, or even a C corporation, although the C corporation is a big trap one. You have to be careful if you do that. There's a self-employment tax that you pay because attorney is one of those professions that's considered to be a personal service business. So if you're in a personal service business, all the income that you make in a partnership or in a proprietorship passes through to you on your personal return, and you then have to pay not only regular federal and state income taxes on that, you have to pay self-employment taxes on that up to a relevant range. Self-employment tax net about 14%. So if you make $100,000, you're potentially on the hook for $14,000. If you become an LLC, or an S corporation, or if you're an LLC elected to be taxed as an S corporation, you can legally avoid the payment of some of that self-employment tax as long as an S corporation, you get a W-2. You must take a reasonable salary. And the IRS has various definitions of reasonable salary. You kind of have to determine what a reasonable salary, what the going rate is for you in that business doing what you're doing. And once you do that, you have the option of passing through other items, the other items of income through to yourself without paying that self-employment tax. Within a business itself, there are some things that you spend cash for that aren't necessarily expenses. And those include dividends, distributions, loan payment. Those things you might spend cash for, but they're not deductible on a tax return. And I think the example we gave was where you had $105,000 of income before you made your loan payment. You made $100,000 in a loan payment, and in your head you're saying, well, I only have $5,000 left. I only have to pay taxes on $5,000. That's not true. Other than whatever interest you paid as part of the loan, which is probably less than $10,000, the remainder of that $105,000 is fully taxable to you on your return. You spent the cash, but you're not allowed to deduct it on your return. You need to look at what you're spending money on and what you're going to spend money on in the future. There's certain tax advantage things that are available to lawyers that include direct write-off, the Section 179 write-off of fixed asset purchases. And you have to keep and that's like when you buy a computer or an item of personal property. Certain items of advertising, certain items of promotion are going to be deductible. You have to be careful, though, that you're using whatever it is for business purposes. You can use the company use of an automobile is one example of something you can write off. You can't write off your personal part, but you can write off your business part. I talked about the one trap that people sometimes fall into. They think that by putting advertising on a vehicle that it makes it 100% business use. It doesn't. The fact of the matter is it's just a simple calculation of how many miles you use it for business, how many miles you use it for personal.